Want to know how the pros invest in the NASDAQ to hunt for those huge returns? It's not about luck or just chasing hype. It's about a professional playbook. And today, I'm going to walk you through that exact playbook, step by step, so you can stop gambling and start investing with a real strategy. First things first, what is the NASDAQ? And why should you care? The NASDAQ is home to the world's most innovative and fastest growing companies. Think technology, think disruption. Its main indexes, the NASDAQ Composite and the NASDAQ 100, are packed with names, like Nvidia, Apple, and Amazon. This is where you find companies with the potential for massive growth. But here's the trade-off. With big potential upside comes higher volatility and sharper downturns. So, if you want a shot at outsized returns, the NASDAQ is the place to be. But you have to be prepared for the ride. So, how do the pros navigate this? They use a two-pillared approach. Preserve capital and hunt for growth aggressively. This sounds simple, but it's the secret sauce. It means you have strict rules to protect your money, so one bad trade doesn't wipe you out. A classic rule many pros live by is the 1 to 2% rule. Never risk more than 1 or 2% of your total portfolio on a single trade. You calculate this based on your entry price and where you set your stop loss. This discipline is what separates a professional from a gambler. It keeps you in the game long enough for your winning ideas to pay off. Now, let's talk about style. Successful NASDAQ investors usually fit into a few different archetypes. You can pick one or even blend them. First, there's the long-term growth investor. These are the people who bought Amazon or Nvidia years ago and held on. They look for companies with a strong competitive advantage, accelerating revenue, and a huge market to grow into. This style is all about patience and conviction, holding through the inevitable ups and downs to capture massive compound returns. Next is the thematic investor. This person goes all in on a big idea, like artificial intelligence, cloud computing, or biotech. They find a powerful trend and concentrate their capital in the best companies within that theme. The returns can be explosive if the theme takes off, but you also risk big losses if the trend fizzles out. Then you have the core and satellite approach. This is a very popular and balanced strategy. You hold a core position in a NASDAQ ETF, like the QQQ, which gives you broad exposure to the biggest names. Then you use a smaller portion of your capacity or satellites to make concentrated bets on individual stocks or options you're really excited about. This gives you the best of both worlds. A stable foundation with shots at high-growth opportunities. For those who are more active, there's the momentum or swing trader. They use charts, price action, and volume to ride trends that last for days, weeks, or months. This works incredibly well with NASDAQ's often trend-driven stockies, but it demands sharp execution, tight risk control, and the ability to act fast. Finally, there's the quant investor. They use data and systematic rules to invest based on factors like momentum, quality, or growth. This approach removes emotion from the equation but requires a solid understanding of data and disciplined rebalancing. A pro tip: many of the best investors blend these, often using that core ETF plus satellite model to build a robust, diversified portfolio. Okay, let's get tactical. How do winning investors actually find and time their trades? It starts with a fundamental deep dive. Before they even think about buying, they read everything: company reports, management calls, and product roadmaps. They want to know if the company's growth is sustainable and if its profits can expand as it gets bigger. Is this a great business, or just a good story. Once they have conviction in the business, they use technical analysis to find the perfect entry point. A key tactic is to buy on constructive pullbacks instead of chasing a stock after it has already skyrocketed. They wait for it to pull back to a key technical level, like its 20 or 50-day moving average. Within an established up, this improves the risk-to-reward ratio of the trade. They also look for breakouts on high volume. When a stock breaks through a key resistance level, a surge in trading volume suggests that big institutions are buying in, confirming the move. And finally, they look for relative strength. They want to own stocks that are outperforming the overall NASDAQ index, especially during market rallies. These are the leaders. Now let's talk about a powerful but risky tool. Options. Experienced traders use options to generate income, get leverage, or hedge their positions. But a word of caution. This is an advanced game. A common strategy for generating income is selling covered calls against stocks you already own. You collect a premium, which provides a bit of a downside cushion, but you cap your potential upside. To protect against a big drop, you can buy protective puts. This is like buying insurance on your stock position. But before you touch options, you must understand a concept called implied volatility, or 4. Buying options when 4 is sky high is a classic rookie mistake that can cost you dearly. Always check the IV ranked before placing an options trade. All of this is useless without elite risk management. This is what truly separates the winners from the losers. We already talked about the 1 to 2% risk rule for position sizing. You also need to plan your exit before you even enter a trade. Many pros use a 2-tier stop system, an initial tight stop loss to cut a losing trade quickly, and then a trailing stop to protect profits once the trade starts working. And when you're trading, especially in the volatile pre-market or after-hours sessions, use limit orders. This prevents you from paying a much higher price than you intended due to thin liquidity. Finally, set position caps. Decide on a maximum percentage of your portfolio that any single stock or theme can represent. This prevents one bad bet from sinking your entire ship. So, where do you find these great ideas? The pros have a routine. Every week, they screen for stocks showing relative strength, getting earnings upgrades, or seeing insider buying. They create a tiered watch list. Tier A is for high-conviction ideas ready to be traded. Tier B is for great companies they want to buy on a pullback. And Tier C is for names that need more research. They build their portfolio in buckets. A core bucket for ETFs, a growth bucket for their best individual stock picks, a trading bucket for short-term moves, and a cash bucket to stay flexible and ready for opportunities. Beyond the numbers and charts, psychology is a huge part of the game. The golden rule is to let your winners run and cut your losers fast. It sounds cliché, but a few big winners are what drive the majority of long-term portfolio gains. You also need to fight confirmation bias. Actively seek out reasons why your investment thesis might be wrong before you pour more money into a position. And finally, keep a trade journal. Write down your thesis, your entry, your exit, and the outcome. Review it regularly. This is how you find your edge and stop making the same mistakes over and over. Just look at the history of the NASDAQ. The biggest winners, like Nvidia, were created by investors who understood the long-term story. In that case, AI and data centers and had the conviction to hold through extreme volatility. The patience paid off massively. Others made their fortunes by riding momentum during powerful rallies, using strict risk controls to lock in gains along the way. There are many paths to success. So, let's wrap this up with a practical checklist. Before you ever hit that buy button, ask yourself these questions. What is my thesis? Why this stock? And why now? What is my time frame for this investment? Have I calculated my position size to risk no more than 1 to 2% of my capital? What's my entry plan and, just as importantly, my exit plan? Do I need to hedge this position with options? And please, avoid these common mistakes. Chasing hype without doing your homework, using too much leverage, ignoring liquidity, and trading news blindly. To get started today, here's a simple 3-step action plan. 1. Consider a core satellite structure. Buy a NASDAQ ETF like QQQ for your core and keep some cash ready for individual ideas. 2. Create a watch list of 8 to 12 stocks you're interested in. Define your entry rules and your stop-loss levels in advance. 3. If you're trying a new strategy, paper trade it first. Practice until you can prove you have a repeatable edge before putting real money on the line. The NASDAQ has produced some of the greatest investment wins in history, but it's a demanding arena. This playbook gives you the framework the pros use, but is not personalized advice. Always consider your own risk tolerance and financial situation. I hope this professional playbook helps you approach the NASDAQ with more confidence and a real strategy. If you got value from this video, please hit that like button and subscribe for more content to help you become a smarter investor. Thanks for watching, and I'll see you in the next one.